Okay, hello everyone. So today we are going to solve some questions from our new chapter. And the title of this chapter is Foreign Currency Transactions. So this is quite important topics for the advanced accounting. So you can see what is the meaning of this foreign currency transactions. So transactions in a foreign currency must be translated or expressed in terms of dollars. That means if your company belongs to China, for example, then all the transactions with foreign country, you have to translate or convert into RMB, right? Same if your company belongs to US, then all the transactions with other countries, you have to translate it foreign currency into dollar. For example, US company export or first import goods from Germany. So if this is the case, so you import, your company belongs to US, you import goods from Germany. So you have to pay, that is payable, you have payable. Okay, you are liable to pay euro. You are liable to pay euro. That means you have to buy euro, right? By using your dollar. By using your dollar, you have to buy euro and pay euro to the German company. In other case, US company export goods to Germany. In this case, we have receivable. So the Germany company will give us euro. And what we have to do? We have to convert euro to our dollar. Okay, to the dollar. So we have payable of foreign currency, we have receivable of foreign currency. So this kind of foreign currency we are going to translate. Translate means we are going to convert, or we are going to express in terms of the dollars. Do you understand? So whatever, if you think about China, okay, whatever you export or whatever you import, it's related with foreign currency. You have to convert it to the RMB. So all the concepts are similar for any countries. Okay, just we are going to convert foreign currency into our own currency. Anyway, this is the main theme. And you know that this kind of foreign currency, the value of dollars or the value of the foreign currency always fluctuating. Whatever you have rate today, okay, what is the dollar rate today? Maybe 30 minutes later, it is another date, another rate. Tomorrow, maybe another rate. So the rate is always fluctuating. So as rates are always changing, okay, so you may have some gain or loss. So today we are going to see how to record gain or loss if foreign currency rate is changing. Okay, foreign currency rate changing, we may have gain or loss. And for your information, this kind of gain or loss, we have to report it under income statement. Okay, under income statement. Now we should know some exchange rate terminology. We should know some exchange rate terminology. First is called the direct exchange rate. We have direct exchange rate, we have indirect exchange rate. So your question may give you direct rate or indirect rate. Okay, so it doesn't matter. So I'm going to teach you, if you have given indirect rate, how to convert it into the direct rate. Okay, so it's very easy. So what is the meaning of direct exchange rate? Look at the definition. Definition is here. Domestic currency that can be converted into 1 unit of foreign currency. That means your currency is going to convert it as a foreign currency. So it is called the direct exchange rate. I repeat again, units of domestic currency. In your case, for example, it is dollar, that can be converted into foreign currency in euro or pound, something like this. So direct rate is given here. Question give you the direct rate. If direct rate is given, it means that if you want to buy 1 pound, 1 British pound, look at here, if you want to buy, okay, so when we buy the foreign currency, if it is payable, right? If it is payable, then you have to buy the foreign currency. So if you want to buy 1 pound, British pound, how much dollar you have to spend? You have to spend $1.517. So this kind of rate is called direct rate. That means you want to buy foreign currency, okay, by using your own currency. What about the indirect exchange rate? That means you receive some foreign currency. Now you want to convert foreign currency to your own currency. So it is called the indirect exchange rate. And if your question give you this kind of foreign currency, okay, so your question give you foreign currency, and if you want to convert it in your own currency, this is the formula: 1 divided by the rate. Okay, 1 divided by the rate becomes the indirect rate. So now what is the meaning? That means if you want to buy $1, okay, then you have to pay 0.6592 British pound. That means foreign currency converted into 1 unit of your own currency. You need, that means 0.6592 British pound is required to buy $1. So not very big deal. When I will solve the question, it will make you more easy. Now, what is the meaning of a spot rate? A spot rate is the rate today. What is the rate today? That means today you are going to make transaction with a foreign country. So what is the rate today? It's called the spot rate. The question will also give you this information. You don't need to worry about this. What is the future rate? Future rate means the rate. I told you that the rate is going to change in future. And the question will give you some expected future rate change. Maybe today, for example, today is November 15. The question will give you what is the rate December 31st. What is the rate maybe another day. Okay, so this is called the future rate. So spot rate means today's rate. You have future rate. And another important terminology for this chapter is called forward exchange contract. Forward exchange contract means a third people came. So we have two parties here, you know that. Mainly we have the exporter, we have importer. So these two group of people, that means we are going to import and export our product. And third party came. Third party is foreign currency exchange dealer. Foreign currency exchange dealer. So this is third party, foreign currency exchange dealer. Now, I already told you that because of this change, increasing or decreasing, you have some gain or loss, right? Now a third party came and give you some assurance. They told that, give me some fees, okay? And you no need to worry about the future rate. So I will give you a fixed rate in the future. So according to the contract, for example, contract said that today is May, right? Today is May 2023, maybe 1 year later or 5 months later. Anyway, for 5 months later, 5 months later, the rate should be, for example, any rate I can write, a rate should be 1.20, for example. So 5 months later, try to understand, 5 months later, what is the rate at the time in the market? It doesn't matter. I will give you, this is the rate. Do you understand? So today you make contract with a third party. Today you make contract with third party that you are going to pay some money 5 months later to Germany or UK or any other country. So 5 months later, what should be the rate? Okay, it's maybe you're favorable, it's maybe you're unfavorable, right? You don't know what will happen in the 5 months later. So third party said that, don't worry, give me some fees. And I am going to give you guarantee that. I am going to give you the guarantee that 5 months later, when you are going to make payment, the rate should be $1.2. You understand? So this is called the foreign currency exchange dealer. That means the foreign exchange, forward exchange contract. You are going to make a contract with a third party. They give you guarantee about the future rate. Okay, and they give you rate today. They told you that this is the rate. 5 months later, you can pay. And what is the floating rates? I told you that because of supply and demand of foreign currency, because of economic factor in this world, this kind of exchange rate always fluctuating. As it is always fluctuating, it is called the floating rates. Now look at the examples. Look at the examples. The example will give you more clear idea about this topic. Don't worry. So we have two important dates here. Actually, we have three important dates. This example is talking about two dates. First, the transition date, and another is the settlement date. Settlement date means the payment date. The payment date. So today you have transition, so it is called the transition date. What happened today? You can see that today, for example, this is RMB. Think about RMB. Think about RMB here. So according to the transition date, you are going to pay, you are liable to pay $100,000 RMB. Okay, so the transaction between US and China, for example, the transaction between US and China. So US company is liable to pay $100,000 RMB. So this is the transition date. They have to pay $100,000 RMB, sorry, 100,000 RMB, and in the payment date also 100,000 RMB. Okay, so this is the RMB they have to pay. Now look at the rate. Rate is different. Transition date rate is $0.0034. That means to buy 1 RMB, okay, to buy 1 RMB, you have to pay $0.00434. Now what is the liability? That means you have to if you convert 100,000 RMB to dollar, according to the transition date, it is $434. You are liable to pay this money, right? According to the transaction. But payment date came. Payment date is another date, maybe 2 months later or 3 months later. When the payment date came, we find that the rate is changing. The rate is changing. The rate is changing means this rate is favorable or unfavorable? What do you think? Compared to this rate, unfavorable, right? Because the rate become higher. So this is your new liability, right? This is your new liability, $6 to $5. That means you have to pay more money. You have to pay more dollars. So this is unfavorable rate. Look at another example. According to the transaction date rate, it is $0.00434, but payment date came, it is $300.00300. So this rate is favorable, right? Because when payment date came, look at here, when payment date came, the rate became lower. So now you are liable to pay $300, but according to transaction, you are liable to pay $434. So the second example, it is favorable to you. You have a gain, right? You have a gain. So anyway, so we have to do this. Now we have to find out, we have another way to understand our gain or loss. That means according to this example, you can see that this is the direct exchange rate, right? This is the direct rate. So what is the summary here? The summary here is if direct rate decrease, right? If direct rate increase, it is unfavorable. If direct rate decrease, it is favorable. So you can see here, direct exchange rate increasing or direct exchange rate decreasing. What is the happen? If direct exchange rate increasing, you need more dollar, right? You need more dollars. Why more dollar need? Because your rate increasing. Look at here. Your rate increase, you have to pay more dollar, right? You have to pay more dollar. Here, your rate decrease, you have to pay less dollar. Like here, direct exchange rate decrease means you need less dollar. Clear? In another way, you can explain. In another way, you can explain. Foreign currency become strong. If foreign currency become strong, then you have to use more dollar, right? Do you understand? Foreign currency become very strong. Then you have to, when you buy foreign currency, you have to pay more dollar. Another way, foreign currency become weak. If foreign currency become weak, if you want to buy foreign currency, you have to pay less dollar because foreign currency is getting very weak. So you can explain two ways, okay? Or I use or sign here. That means when a rate is favorable to you, when a rate is unfavorable to you. You can explain both ways. First, if your rate increase, you have to pay more money. If your rate decrease, you have to pay less money. Think opposite. Foreign currency become very strong. It means that you have to pay more money. Foreign currency become weaker, you have to pay less money. So this is the overall concept for import and export business, and the direct rate increasing or decreasing, whether direct rate is favorable or unfavorable. So if it is favorable, we have gain. If it is unfavorable, we have loss. And we have to transfer the loss or gain to the income statement. Now look at three important dates: transaction date, balance sheet date, and the settlement date. If these three dates are different, we have to calculate gain or loss several times. What is the meaning of transaction date? For example, today is 15 May. Today is 15 May, we have transaction. We have one rate here, right? Then our payment date, look at here, our payment date is February 21st, 2024. Another payment date. If your settlement date and payment date is 2 different years, that means that in between we have another important date is called the balance sheet date. At that date we prepare financial statement, and at that date we have to calculate the real amount of gain or loss that is going to transfer to the financial statement, right? I repeat again, if your transaction date and payment date is 2 years, and in between if you have December 31st, why this date is important? Because here you prepare the financial statement, and when you prepare the financial statement, you recognize gain or loss that transfer to the income statement. So we have to compare all the dates, okay? All the dates to see our gain or loss increase or decrease. And as we have 3 important dates, we have to adjust this gain or loss again and again. We have to adjust. So this part I already explained, don't worry, this part I already explained. So let me explain the class problem 1. So according to the class problem, you can see that during December of the current year, Teletext system is based on Washington. That means US company. US company entered the following transactions with Colombia. So 2 companies here, one is US company and another is Colombia. We are doing the journal entry by following US company. So this is the transaction date. You can see that transaction date is December 10. Sold 7 office equipment to a company located in Colombia. So US company sell equipment to Colombia, and this is the money of Colombia. Colombian money called pesos. So 8,541,000 pesos you will receive. That means Colombia will give you this peso, right? You have to convert this peso to the dollar. And a spot rate, what is the meaning of a spot rate? Can you remember? The rate today. Today's rate is, look at it, 365 pesos. So this is indirect, right? Why indirect? Because it is not US dollar rate. It is the rate of foreign currency. So we have 2 ways to do this. We can convert it indirect rate to the direct rate. That is 1 divided by 365. Okay. 1 divided by 365, we can convert this rate to the dollar. Anyway, so what is the journal entry for the transaction date? What is the journal entry for transaction date? This is the journal entry. So we can, according to this table, this is the transaction date, you can see, and this is the payment date. This is the payment date. Transaction date and payment date we have, and it is 2 years. It means that in between we have December 31st. Anyway, it depends on the question. Let me explain this. US company sell inventory to Colombia, and Colombia, okay, payment date came. When the payment date came, Colombia sent 8,541,000 pesos to the US company. Do you understand? Now let's see the journal entry. So this is the first journal entry based on the question. Okay, US company sell it, so they record sales revenue, right? Sales revenue credit and accounts receivable debit. Accounts receivable debit, that means this money they will receive in future. This money they will receive in future. So they will receive pesos, okay? They will receive pesos, but they are going to convert. They are going to convert pesos into dollar. So that's why we divided by. Look at it. That's why this is the pesos divided by the indirect rate. Okay, it's become the dollar. It's become the dollar. Okay, it's become the dollar. Do you understand here? So this money you will, this dollar, although that means, although it is pesos, this pesos you will receive in future, but we already converted it to the dollar. So accounts receivable debit means you will receive this money in future because you sell it. And the question said that they follow periodic inventory method. Periodic inventory method means you no need to record cost of goods sold. You understand? You no need to record cost of goods sold, only sales revenue and receivable. Now you know that this transition date is December 10, payment date is January 10, another year. So in between we have December 31st, and December 31st may be another rate. Okay, December 31st may be another rate. So we are going to see whether we have any gain or loss on December 31st. Look at the calculation of December 31st. So we are going to receive, this is the money we are going to receive. Okay, this is the money I'm going to receive, and according to the, so this is the rate, yes. This is the balance sheet date rate. Balance sheet date rate. So look at it, balance sheet date rate already given in dollar, right? So you no need to divide it. 1 divided by the rate. You no need to do that, right? Because it is already dollar. It is already dollar. It is already dollar. So this is the balance sheet rate. Try to understand. According to the balance sheet, according to the balance sheet, this is our receivable. Balance sheet said that today's rate is this one. Today we are going to prepare financial statement, right? Today we are going to prepare financial statement, and we are going to record receivable $22,890. Clear? But according to the transaction date, what is our receivable? According to the transaction date, our receivable is, according to the transaction date, our receivable is here. This one, right? This is the receivable according to transaction date, but balance sheet said that it should be $22,890. So obviously we have a loss. What is the meaning of accounts receivable? Accounts receivable means you will receive this money in future. Balance sheet told me that in future you will receive $22,890. But our journal entry said that we are going to receive $23,400. So which one is the accurate one? This is the accurate one because we follow the balance sheet, right? Balance sheet said that we are going to receive less money. As we are going to receive less money, it is our loss. That means our accounts receivable is going to decrease. So that's why our accounts receivable decreased $510. We record loss. Okay, we record loss. But this is not the actual loss, because we have the payment date. Okay, payment date rate may be different. Payment date may be different. Look at the settlement date or payment date. This is the payment date rate. This is the payment date rate. Okay. So at the payment date, you are going to receive the cash, because they will give you this money, right? This is the pesos. This is the pesos. We convert the pesos because we receive today is the payment date. We receive 8,541,000 peso. Now we convert it into dollar. So this is the rate today. Look at it. This is the today means this is the payment date rate. Based on the payment date rate, we receive this dollar. This is the final amount we received, right? This is the final amount we received. But what is the balance of accounts receivable? You can say that we have two accounts receivable. First, we record accounts receivable debit. Now we have to prepare a T account. You have to prepare a T account. So accounts receivable debit, again accounts receivable credit, right? Look at here, accounts receivable debit, accounts receivable credit. So this is the real accounts receivable. This amount is the real amount. Our real accounts receivable is $22,890, but we receive 27, right? That means finally we have a gain. Finally, we have a gain. Our gain is $4,441. Do you understand? Now we have a gain. We record gain actually, and we had a loss here. Now we can see what is the real gain or loss, right? The real gain or loss is something like this: loss 510, gain 4,441. We can have a net gain, right? We have a net gain. So this is not the journal entry. We do not have any journal entry for the net gain, something like this. But do you understand here? Any question? Okay. So the same question, I just changed the number. Same question, I just changed the number. You can practice it at home. Okay. Now we have another question, problem 2. Problem 2 is based on the import. Before you export, right? Export means you will receive this money. Now we are going to import, right? You are going to import means you are going to buy something and you have to pay $1. Look at the question. December 31st, December 12 is the transaction date. December 12 is the transaction date. You buy something from Taiwan, okay? And what is the Taiwanese dollar? So this is the Taiwanese dollar. So you are liable to pay this dollar. You are liable to pay 500,000 Taiwanese dollar, and the question already give you direct exchange rate. Direct exchange rate means you no need to make it division, right? You no need to divide any number. So already direct rate. If it is indirect rate, then this amount divided by this amount convert direct. Okay. Anyway, very easy. So you import, you're liable to pay this dollar, and this is the rate. So you receive inventory from Taiwan, and another year, another date, you have to pay this dollar. You have to pay this dollar. So what is the journal? You can see that you purchase debit and accounts payable credit, right? Accounts payable credit, and this is the calculation. This is the calculation. So you're liable to pay this money. You're liable to pay. This is the Taiwanese dollar times this is your rate. This is your rate. According to the transaction today, this is your liability. But the balance sheet date came, look at here. When the balance sheet date came, you have another rate. That means before the rate was 0.391, now the rate is 0.351, right? So it is favorable to you. It is favorable, right? It is favorable, so you record a gain. You record a gain credit, and as it is your gain, you don't need to pay this money. So your liability decreased debit. But the payment date came. When the payment date came, look at here. Payment date is unfavorable. In the payment date, the rate became higher, right? Rate become higher means you have to pay more money, more dollar to Taiwan. So this is your real payment. This is your real payment. So you are going to pay 500,000 Taiwanese dollar, and the rate of dollar is this. This is your payment. And when we do T account, for accounts payable, we find that our real liability is this. This is our real liability. So we are liable to pay $17,550, right? We are liable to pay, but actually we are going to pay them $19,900 US. So ultimately we have a loss. Again, this is your real loss? No, because you have gain here, right? You have gain here. So gain 2,000, loss $2,350. That means $350 is the net loss, something like this. That will transfer it to the income statement. Yes. So again, I change this question. Okay, and I just change the rate. Okay, if you understand this, any rate we have gain or loss, something like this. Now I am going to move on the little bit difficult part. Difficult part is about forward exchange contract. So what is the meaning of forward exchange contract? I already told you that a third party will come and tell you, give me some fees, and no need to worry about the future rate. I am going to give you guarantee a rate today. Okay, today I am going to give you a rate, and in future, whatever the rate, follow my contract rate. Okay, so if you want to avoid gain or loss, okay, if you want to avoid this kind of loss or gain, anyway, especially loss, then you can have a contract with third party. So this is about forward exchange contract. So a forward exchange contract, okay, now pay more attention because this is difficult. A forward exchange contract, that means the forward contract is an agreement of exchange currencies of two different countries. Okay, so you are going to make agreement. When this agreement came, if you want to exchange currency of two countries, and this agreement is going to give you a specified rate. Okay, this agreement is going to give you a specified rate. Okay, in future on a specified date. Yes, so a date. Here the date means actually you can select a date. It is your choice which date you want. Do you understand? When you make a contract with me, it is your option to select a date. You can select today's date, okay? You can select balance sheet date, or you can select another date, okay? But the rate is going to say today. But the rate when you will pay is depends on any future date. It doesn't matter. I repeat again. So the rate is going to fixed, right? Today we are going to fix a rate, and today also we are going to fix a date. When should be the date for this payment? Do you understand my point? Maybe you have 3 people here. So today you have a contract with me. One people said that I want to lock my rate today. Okay. Another people said that I want to lock the rate another day. Okay. So if you lock, do you understand what is the meaning of lock? If you lock a rate, okay, you cannot change it. You cannot change it. So today's rate, for example, spot rate means today's rate. Today's rate is $1.16. Okay. Future rate may be higher, future rate may be lower. And if future rate is higher, it is called premium. If future rate is lower, it is called discount. So if you are importer, okay, if you are importer, look at here, future rate become higher. Importer means you have to pay more money, right? So in case of importer, if future rate become higher, you are going to lose your money, right? If you are exporter, if future rate become higher, you are going to gain your money, right? Same in case of discount. If you are importer, okay, that means in future exporter, in future you will receive this money. That means you are going to sacrifice money because the rate is lower. So as if you are importer exporter, you have opposite scenario. Anyway, we have premium rate, we have discount rate, it doesn't matter. Read the question carefully. The question will give you a clear idea. Okay, if you have any question, you can stop me anytime, but very, very critical concept here. So Crystal Exporting Company is a US company. Following transactions are dealing with international business. The company uses periodic. Periodic inventory means you do not have any cost of goods or journal entry. Clear? And you follow a calendar year. What is the meaning you follow a calendar year? That means in between payment date and transaction date, okay? If you have December 31st, you have to adjust your gain or loss. Do you understand? Payment date and settlement date. If this is two different dates, and in between, if December 31st came, you have to recognize gain or loss at that date because your company follow calendar year. Calendar year means December 31st, prepare financial statement. This is called the calendar year following, right? Very simple. It is not a big deal here because we already know that if December came, if we have another rate, we adjust our gain or loss. So introduction part is not a big deal. Look at the transaction date. This is the transaction date. So Crystal Exporting purchase merchandise from Hong Kong. Okay. So US company. So here US and Hong Kong. And you are now you exporter. US company are the exporter, right? No, sorry, exporting. This is company's name. Purchased. That means US company going to purchase. Your company going to purchase merchandise. That means at this moment, US, your company is importer. Your company is importer, right? That means you have to pay Hong Kong dollar. You have to pay Hong Kong dollar. And how much Hong Kong dollar you have to pay? This is the Hong Kong dollar you have to pay. According to this question, you are liable to pay 210,000 Hong Kong dollar. When is the payment date? Look at it. Transaction date is December 1st. Transaction date is December 1st and payment date is April 1st. It means that in between we have calendar year, right? In between we have calendar year. So April 1st is the payment date. On this same date, the US company acquired a forward contract. So third party came. Okay, a third party came. So you make a contract, you are the US company, you acquired a contract with a third party to buy this dollar, Hong Kong dollar, okay, from the dealer. Okay, you will buy this money from a exchange dealer. Okay, when? On April, because April is the payment date, right? When the payment date came, the exchange dealer, here contract means I can make it easy here. Foreign currency exchange dealer. The foreign currency exchange dealer, okay, give you a guarantee that when April 1st came, okay, they will help you to pay this 210,000 Hong Kong dollar, and their rate at that time, their rate should be $0.1314. Do you understand my point? Third party came and said that don't worry, when April 1st came, I will give you US dollar, okay, and you have to give me for one Hong Kong dollar, you will give me $0.1314. So September 4 came, okay, April 1st came. I am the US company. I will pay $1.1314 to the exchange dealer, okay, and they will pay the money to the Hong Kong. Okay, I don't care what is the money they will pay. My payment is 210,000 times $0.1314. I will pay this money to whom? I will pay this money to the exchange dealer. And exchange dealer will pay the money to the Hong Kong, whatever their rate, I don't care. Now April 1st came, okay, look at here, April 1st came, US company make full payment to whom? Full payment to the dealer, forward contract, look at here. April 1st came, US company pay dollar to exchange dealer will pay this money to whom? To the Hong Kong. So this is the thing here. You can read here again. So April 1st came, the Crystal Exporting submitted full payment of Hong Kong dollar, okay? Hong Kong dollar, obtaining, look at obtaining this money, okay, based on the forward contract. So based on the forward contract, they pay everything to the Hong Kong. It doesn't matter. And look at the rate here. Today is the transaction date. Transaction date, this is the rate, dollar rate today. This is the balance sheet rate today. So compare these two. You have gain or loss. Transaction date is 12/6/5, but the balance sheet date is 12/5/9. So when balance sheet date came, you have to recognize gain or loss, right? When balance sheet date came, you have to recognize gain or loss. So you have gain or loss, of course gain, right? Because the balance sheet rate is lower. Clear? Now, this is the rate of April 1st. Payment date. Payment date rate is 14.30. What do you think? Do you have a gain or loss? If you compare these two, for example, you don't have any third-party contract. Think about our example 1 or example 2. So December 31st rate, and this is the payment rate. If you compare these two now, you have, it is favorable or unfavorable. Your balance sheet date rate was 0.1259, but the payment date rate is 0.1430. You have favorable or unfavorable rate because you have to pay this money. Unfavorable, right? But third party said that don't worry, because when payment date came, this is the contract, and you locked here. You already locked this number. Do you understand? What is the meaning? You already locked this number. That means when the payment date came, you have to pay this dollar. You have to pay this rate. Although look at here, although the rate will be $14.30, okay? But what is your sacrifice? You are going to sacrifice only $134 because you locked here. Do you understand what is the meaning of locked? Now, very interesting, you can see that when December 31st came, this is the rate of exchange dealer, right? This is the rate of exchange dealer. So December 31st rate of exchange dealer is $0.1308. But you cannot come here, right? Why you cannot come here? Because you already locked here. But this information you collected because you are the accountant. You collected this information that December 31st rate of exchange dealer is $0.1308. So this is a good news or bad news for you? You already locked, look here, you already locked on April 1st, right? And April 1st you locked, that means this is your April 1st payment. Your April 1st payment should be $1314, and you locked it when? You locked it on December 1st. Clear? Because you have option. I am the dealer. I tell you that you have two options. You can lock today, or you can lock December 31st, or you can lock another day. But you choose here. You choose to lock on April 1st, right? Sorry, December 1st. You already locked it. December 1st, you already locked this rate. But when you collected some other information from exchange dealer, when the balance sheet date came, you find that at that date, the exchange dealer rate is $1308. It means that you lost some money, right? Do you understand my point? Very good. So this is the critical one. If you understand here, that means you understand everything almost. Because we already locked here. we cannot come here. But when we find some new information, we feel very sad that if we locked here, that we can save more money, something like this. Now, based on this information, we are going to solve some journal entry, like what is the journal entry for the transaction date, what is the journal entry for the balance sheet date, what is the journal entry for final payment date. Okay. Now, go back. Let me explain the summary. Let me explain the summary first, because the summary will give you more clear idea. Okay. First, think about here up to here, because we have two parts. Think about the left side first. Then we'll move on to the right side. December 1st is the transaction date. Okay. And at that rate, I copied from the question, right? At that rate, the US dollar rate was, okay, put the US dollar sign here, because if it is US dollar sign here, it means that this is the direct rate. Do you understand? Direct rate. Yes. So this is the direct rate. Direct rate. I can make it more easy for you. Direct rate. So if the question give you indirect rate, you can convert it into the direct rate divided by this number. Okay, so look at the transaction date first. At that date, okay, this money you are liable to pay, Hong Kong dollar. This Hong Kong dollar you are liable to pay. And what is the rate? And the rate is $0.1265. So this is your liability, right? This is your liability based on the transaction date. You are liable to pay this money, you record journal entry. Now, balance sheet date came, December 31st came. December 31st came because we follow calendar year and we have to prepare financial statement at that day. At that day, the rate is different. The rate of transaction date, okay, rate of transaction and rate of balance sheet is different. So this is according to the balance sheet rate, okay, this is my liability. According to the balance sheet rate, my liability should be $24,439, right? $24,439. This is my liability. This is my liability. Now, if you compare these two, we have gain or loss. We have gain, right? Because we have less liability, so we have a gain. I think you understand here, right? You understand here. Now, look at the balance sheet date rate and the payment date rate. So when the payment date rate came, the rate is too much. Okay, the rate is too much. That means according to the payment date, this is my liability. This is my original liability because this is the payment date came, right? Payment date came, this is my original liability. Original liability. So compared to balance sheet, now we are going to compare. We are going to compare balance sheet rate and the payment date rate. Okay, if we compare these two, then we have loss. Do you understand? We have loss. And this is the net loss. This is the net amount of loss because we have some gain, right? We have some gain and we have some loss. So this is the net amount. Clear? Now you make a contract with third party. You make a contract with the third party. Look at here. Although when the payment date came, look at here, this is the payment date. When the payment date came, try to understand this one first. When the payment date came, this is your liability. This is your liability, right? But you already have a contract. According to the contract, you no need to pay this money. How much money you have to pay? You have three numbers. Try to tell me which number you have to pay. Yes, very good. This one, right? This one. This is actual, you have, because you locked here, right? According to the hedge contract, according to the FC means foreign currency, okay? FC means foreign currency. According to the contract, whatever the future rate, look at here, whatever the future rate, it doesn't matter. It doesn't matter whatever the future rate. You are going to follow this rate, right? You are going to follow this rate. So thank you very much. You should know that when the payment date came, although this is your liability, who will pay this liability? Can you remember? Third party, very good. Yes, foreign currency exchange dealer. Foreign currency exchange dealer will pay, liable to pay this money, but we are liable to pay this money to whom? We are liable to pay this money to the exchange dealer, and exchange dealer will pay this money to them. Clear? Very good. You almost understand everything. Now we are going to calculate gain or loss. So this is the transaction date amount, right? This is the transaction date amount, and this is the balance sheet date amount. Because we find that here we already locked. This amount already locked. I can write here. We already locked here. As we already locked and we cannot transfer, okay, we cannot change, we find that the balance sheet date rate, the exchange rate dealer rate is lower than our rate, right? So as we already locked here, we find that balance sheet date rate for the exchange dealer is lower. That means we have a little loss, right? We have a little loss. Clear? Now we are going to compare balance sheet rate, okay? Balance sheet rate and the payment date rate. So this is the balance sheet rate and the payment date rate, okay? We find that we have a gain here. We have a gain here. Do you understand? So we have a gain because according to the payment date rate, okay? This is our payment, right? But the balance sheet date rate is different. Balance sheet date rate is this one. So we compare again, like here, we compare balance sheet and payment, right? Same here. We compare balance sheet and payment to find we have any gain or loss. Okay. Finally, according to the hedge contract, we have a gain. Look at here. Because we go for a contract. Why you go for a contract? Because you want to minimize your risk, right? You want to minimize your risk. So when we go for the hedge contract, this is the net gain, right? This is the net gain. But if you do not go for the contract, this is the net loss. So we adjust these two and we find that actually this is our gain. Okay? Or loss. Let me see which one is higher. Loss, sorry. This is loss is higher, right? Loss is higher, gain is lower. So we find that our actual loss is $1029. We did not lose too much. Do you understand? Because we have a contract. Now, based on this information, we are going to record the journal entry. Okay, we are going to record the journal entry. So first journal, so this is the summary. If you understand the summary, now we'll go step by step. Okay, we'll go step by step. So I make it more clear based on the previous file. Solution. Now we are here in the solution. So according to the solution, we have transaction date, we have balance sheet date, we have payment date, right? So transaction date, we will have how many journals? Transaction date, we have 2 journals. Transaction date, we will have 2 journals. What are the 2 journals? First, we buy inventory from Hong Kong, right? We buy inventory from Hong Kong, and the second journal is we make a contract with exchange dealer. So acquired forward contract with forward contract with foreign currency. FC means foreign currency, okay? Exchange dealer. So this is the transaction date. I repeat again. This is the transaction rate. We have two journal entry because question already tell you that. Look at here. Question already tell you that this is the December 1st transaction date. You import goods from Hong Kong, right? You import goods from Hong Kong and you already made a contract with whom? You already made a contract with foreign currency dealer. So what is the journal entry? Look at here. You purchase inventory, purchase debit, and you are liable to pay this money, liability credit. And this is the calculation. This is the calculation, 210,000 Hong Kong dollar. And what is the spot rate today? This is the spot rate, today's rate. Today's rate is $0.1265. And this is our liability. Okay, this is our liability based on the transaction, but this is not the actual liability. Based on the transaction, this is our liability. Now at that day, we make a contract. According to the contract, we have to pay when the payment date came. Look at here. When the payment date came, we have to pay. We have to pay this money. We have to pay this money to whom? We have to pay this money to the exchange dealer, right? And they will give us this money. So this is receivable because they give us guarantee. They give us guarantee that if we pay this money based on this rate, okay, based on this rate, if we give this money, they will also give me the same rate. Do you understand? The rate for receivable and payable is similar. Whatever the rate in future, it doesn't matter. We are going to, according to our dollar, we are going to pay this to the exchange dealer. Exchange dealer will give us this money. So we have nothing to lose, right? We have nothing to lose according to this contract. According to this contract. So that's why dollar payable to exchange dealer, right? Payable, we have to, this is our contract. I repeat again, according to the contract, I have to pay this money to the dealer. And dealer said that, okay, I will keep the same rate and I will return back to you. Okay, and they give us this money. They will give us this money. So that's why it is receivable from exchange dealer and payable to exchange dealer. So this is the solution for the transaction date. This is the solution for transaction date. Do you understand? This is locked, right? This number is locked. Now balance sheet date came. Okay. Look at here. So if we go back to the summary, we have to compare these two, right? We have to compare these two, and this is our gain. So look at this one first. Balance sheet date came, and the balance sheet date again we have two journal entries. Balance sheet date came. We have two journal entries. You can see here. So recognize gain or loss, right? Based on the transaction date and based on the balance sheet date. Do you understand? This is first journal entry. We have to have another. Okay. We have to have another journal entry, also gain or loss. Look at that. We are going to recognize gain or loss with hedge contract, right? With the hedge contract. Yes. So here you can see that. Now we are December 31st came, we compared these two, right? And we compared these two. Clear? So according to, if we don't have contract, this is our gain. Okay, as we have a contract, this is our loss. Although we are lucky that it is the same amount. Anyway, maybe the number may not be similar, but according to this question, this is similar. Now, balance sheet date came. I repeat again, balance sheet date came. We are going to recognize gain or loss. We are going to recognize gain or loss. Okay, so our first journal is comparing these two, and second compare with the exchange dealer. Okay, compare with the exchange dealer. So look at the journal entry. So now we compare our gain or loss. Okay, look at here. This is transaction date rate, and this is the balance sheet date rate. So this is the transaction date rate. Look at here. This part is the transaction date rate. According to the transaction date rate, this is our liability, right? But balance sheet date said that this is your liability. According to the balance sheet rate, our liability is different. Our liability is different according to the balance sheet rate. So we have a gain, right? As we have a gain, this is journal. Gain is credit. Gain is credit. Why it is gain? Because we no need to pay this money to the accounts payable. So accounts payable debit. Accounts payable debit and transaction gain credit. Clear? Now look at the transaction with exchange dealer. Look at the transaction with exchange dealer. So this is the December 31st rate, balance sheet rate. Look at that. This is the balance sheet rate. This is the balance sheet rate, and this is the transaction rate. I repeat it here again. We are going to compare these two. Balance sheet rate, and we have a contract with him, right? We have a contract with him. So our contractual rate and their balance sheet date rate is different. So we have a loss here. We have a loss. We have a loss. Do you understand this? We have a loss. So these are, so you no need to show me this kind of calculation. You can do it very quickly by yourself. In the exam, you no need to show me this calculation. This is for your reference, so that in later on when you read and alone, you can understand. So this is the balance sheet date rate, and this is here. Sorry, this is the balance sheet date rate, and I mean I have a mistake here, right? This is the balance sheet date rate. Why I write 2 number here? It should be. This is my mistake. Make it correct. Yes. So this is our contract rate with him, right? This is our contract rate with him. Our contract rate is quite higher than their another contract rate in December, because we locked here, right? We locked this number, so we cannot follow their balance sheet. We cannot follow their another rate. So as we locked here, we have some loss. Do you understand? Now, as this is the loss, that means this money we are not going to receive from the exchange dealer, right? We are not going to receive from exchange dealer. So that's why transaction loss debit, and this money we are not going to receive from exchange dealer. Clear? Very good. Now the payment date came. When the payment date came, try to understand here. When the payment date came, try to compare these two. So although the payment date is 0.14 anyway, so the payment date, we have 2 journals. First, we are going to record this gain first. First, we will record this gain, okay? Then we'll pay the money to the Hong Kong company. So how to calculate this gain? Because we compare these two now. Now we compare these two, balance sheet date and the payment date rate. Look at the payment date rate is 1430, but balance sheet date rate was $0.1308. So we compared these two and we have a gain. What is the meaning of we have a gain? That means this money we are going to receive from whom? We are going to receive from the exchange dealer. Yes, look at here. So we have a gain now. Again, let me see the number is accurate or not. So this is the payment date rate, okay? This is the payment date rate in the market, and this is the balance sheet date rate. So we have a gain. So this gain means we are going to receive this money from exchange dealer, so receivable debit. Clear? Receivable debit means this gain we are going to receive from the dealer, and we record gain credit. You understand? Like before, look at here. Before we had a loss, right? Before we had a loss with the exchange dealer. What was the journal? Loss debit, receivable credit. Why receivable credit? Because you will not receive this money. But again we have gain. Again we have gain, so gain credit, and we will receive this money from the exchange dealer. So receivable debit. That means we compare these two. When we compare first two journal, we have a loss, right? Now we compare second, that means balance sheet date and the payment date, we have a gain. Now finally final payment is this one, you know that. Final payment, this is the final payment. Because you have to, you already have the hedge contract, you already have the hedge contract, and whatever you have gain or loss here, right? We just calculated gain or loss for our financial statement purpose, right? For our financial statement purpose, we recognize our gain or loss. But when the payment date came, this is our payment. This is our payment because we locked here. Can you remember? We locked here. So April 1st came. April 1st came. We are going to pay this money. If you pay this money, it means that your liability decrease. 100% of your liability decrease. Clear? Now look at the last journal entry. Look at the journal entry. We pay cash. Look at here. We pay cash this money. This money. $27,594. This money we paid. This money we paid, right? Because we promised. Someone contact us and promise with me that give me this money only. Give me this money only. So I give this money, right? I give it this money. I give this money to whom? I give this money to the exchange dealer because I was liable. Look at the first journal here. Transition date journal. Transition journal. I promised them. I promised the exchange dealer that I will pay this money to him, right? I pay this money. When I pay this money to him, he become debit. You understand? This payable become debit and I pay his money. So compare these two. Compare these two. I pay this cash to the dealer and dealer do not ask me any money, right? Dealer do not ask me any money. So that's why dollar payable to exchange dealer become debit. Do you understand? Now, this is my real liability, right? This is my real liability. Who is going to pay this money? Third party will pay this money, right? So that's why when third party said that they pay this money, we record accounts payable debit. Now this accounts payable debit means we don't have any liability with whom? With the foreign people. Do you understand? And look at here. And as this money paid by the exchange dealer, we don't have any receivable from him, right? Because exchange dealer paid everything, right? Exchange dealer paid everything. It means that we don't have anything from receipt from exchange dealer. So receivable become credit. All closed, right? Everything now closed. We pay cash. We close our liability with exchange dealer. Exchange dealer pay money to the Hong Kong people. Our liability closed. And as exchange dealer paid everything to the Hong Kong people, we don't have anything received from him. We close him, right? We close him. So this is all about this chapter actually. This is all about this chapter. So do you have any question?